I got at least 15 or 20 requests of people asking me about CVS. Did I buy CVS for my portfolio? Is CVS stock a buy? Will the dividend be cut? What do I think of earnings? A lot of questions around CVS. And this is what happens sometimes. And I'm going to discuss these things in a video. I'm going to discuss the dividend, if it's safe, did I buy CVS or not. I'm going to tell you if I had to do something on CVS, what kind of move would I do? And it's a pretty smart thing I'm going to tell you at the end of the video. I think it could be very, very profitable for a lot of people that are interested. But before I get into the analysis, I'm just going to have to quote Warren Buffett on something. He said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And this is what happens sometimes with stocks like CVS. We buy the stock because it looks cheap, but sometimes it's cheap for a reason. And you're saying it cannot get any cheaper. The stock gets even cheaper and it goes down 15, 20%. While a lot of companies, they look expensive or they look at fair value. They are trading at fair value or expensive for a reason because they're performing, and then they grow earnings and the company grows even more and it gets even more expensive. And this is really what's been happening over the last 15 or 20 years. And it's very hard for a lot of people to adapt to this mindset. And I still somehow have a lot of the cheap stocks in my portfolio, but I've been over time switching. I talked about GEO, I talked about Sandstorm, I talked about Pfizer stock and a few of them on YouTube. And yeah, but this is what Warren Buffett said. And he's been so far right. Now for CVS, yes, the stock went down because they had higher medical costs for the insurance business. It wasn't good at all. But Humana and United Healthcare have faced the same medical cost spike. But the only thing that's really bringing a lot of uncertainty to the market is that stocks like United Healthcare have actually maintained their guidance for 2024. And this is why the stock is not down a lot. But something like CVS, they massively reduced guidance. I mean, they pretty much destroyed, they slashed guidance. It's very bad. For revenues, I mean, it wasn't too bad, but they did decrease revenues. The one that concerned me the most was cash from operations. It was $12 billion. And this is what I based a lot of revenues on, numbers on in YouTube. Now it's $10.5 billion. CapEx is still the same at $3 billion. So this would give us like $7 billion of free cash flow, or $7.5 billion, which is almost nothing. And it's just really bad. I'm extremely disappointed from the management and from everything that's happening. But this is not just an industry problem. The market believes that this is a CVS problem because United Healthcare also had these higher medical costs, but they did not reduce their guidance. But something like CVS, they massively slashed guidance. Maybe CVS is trying to be a little bit more conservative, trying to set low expectations so they can beat. But this has been the case over the last few quarters since I started covering the stock in early 2023. I started talking about it, and I actually owned CVS in 2023. Then I made this video, it says bad news, if you remember watching it. And I pretty much talked about the outlook of CVS, how it's reducing guidance. It was expecting $10 of EPS for 2025. Now it's only expecting $8.50, and the trend was going down. So this is when I exited the stock, and right now I do not own CVS, and it just keeps going lower. So I'm not sure if this is low expectations or something trying to beat, but it's just really bad numbers from the company, from the management, and it's not good at all. This is just the truth. Now for long-term debt, the good thing about it is it's coming down from 59 billion now to 57 billion. The management is finally starting to pay down the debt. Now, if you look at the guidance does not include any share repurchases because it's been pretty much the same, or even share outstanding will be going up a little bit. So no share repurchases, no buybacks. It's going to be only dividends and debt pay down, which is a smart move from the management, and they should have done it earlier. Now for the dividend, I know a lot of dividend investors own the stock. The dividend right now is at 4.4%. If one of the highest dividend yield it had over the last 10 years, the highest it had since 2006. This is the data that I have. Now, the question is this dividend yield actually sustainable? Now, if you remember, we talked about free cash flow is going to be around $7 billion. Around $3 billion of that is going to go to the dividend. So the company's dividend is pretty close to a 50% free cash flow payout ratio. It's a little bit high end for CVS. It used to be 15, 20, 25%. Now it's pretty close to 50% payout ratio. They have $7 billion of free cash flow. The dividend is $3 billion. There will be around 4 or 4.5 billion of free cash flow left over. So the dividend is covered, but 4 or 4.5 billion is honestly not a lot of free cash flow for the kind of debt that this company have, over $57 billion, excluding a lot of different debt obligations that they have. They do have the debt, which is $57 billion. Then they have deferred income taxes, $4 billion, other long-term liabilities of $6 billion. So in total, it's like $70 or $71 billion. And only $4 billion of free cash flow after the dividend is really not good at all. And I hope this is the bottom in terms of the estimates for CVS, because if it really gets worse from here, I mean, the stock is really not good. The fundamentals aren't good at all. Now, for the valuation of the stock, it's now only trading at a 12% free cash flow yield. It was trading at a 12% free cash flow yield before the drop. So it's not much cheaper than it was before the drop. Only the price went down. But the price went down with the fundamentals. Free cash flow was expected to be around $10 billion, and it went from 10 billion to 7.5 billion. So the free cash flow yield is still around 12%. And I continue to say that if you're buying CVS today, I would expect the return to be pretty close to the free cash flow yield of pretty close to a 12% annual return, the 4% with the buybacks for dividends, and then the rest will be if they do any buybacks or if they pay down debt and then reduce interest expense. But the company is done doing acquisitions. They're gonna finally focus on the business, focus on paying down the debt, and focus on keeping and potentially increasing the dividend. So again, it's a hard decision to make in terms of buying CVS. If you're looking for if you're a risk taker looking for a safe bet, maybe. But to me, CVS is getting riskier every time the fundamentals get worse. It's been getting from 10 EPS, now it's $7 EPS. It's really, really bad. So it's really up to you. But for me, what I'm looking at doing in CVS, I haven't done it yet, but I'm still looking into it, is to sell put options on it. The $50 put, January 2025, $50 puts on CVS. If you do sell these puts, you will get around $310 of credit for every puts you sold, which is $5,000 you put on the slide. You get $310. This is pretty close to a 6% yield. So you're getting a 6% return from now to January 2025 to get to buy CVS around $50 per share. And if you do buy CVS at $50 per share, you have to remember that you already collected a $3.10 credit, which is $310. So if you take the $5,000 that you would spend to buy CVS and you would, take out the $310, you would end up with a cost basis of $4,690. And if you divide it by 100 shares per contract, your cost basis per share would be pretty close to 46.9, which is $47 per share. So you're getting a 6% return to buy CVS at $47 per share. It would be crazy. The dividend would be, like 6 or 7%, and it would be covered if it gets even worse from here. So, this is to me is a much better bet than buying CVS. I would be looking at selling put options. I get 6% to buy the stock at 50, and my adjusted cost basis would be $47 per share. To me, this is a much better bet than buying CVS over here. But if you own CVS, the dividend is covered if you're a dividend investor. And I don't know if it's going to get worse. I always say it cannot get any worse, and it keeps getting worse. So I'm not sure what to say. But this is just my opinion on CVS. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.